India's healthcare delivery market has reached approximately 6.3 trillion rupees in FY24 and is projected to grow significantly to 9.8 trillion rupees by FY28, a CAGR of 10 to 12%. Such robust expansion underscores India's healthcare sector as an attractive target for investment. India, being the world's most populous country with roughly 1.46 billion people, benefits from the strong macroeconomic expansion, with its real GDP growth growing by approximately 6.5% in FY25. This robust economic growth translated into rising per capita income, which increased from 63,462 rupees in FY12 to 1,08,786 in FY24, a 4.6% CAGR. Furthermore, the expanding middle class and increasing health awareness are driving demand for higher quality and often private healthcare services. Combined with the demographic shifts, including a rising median age and a surge in lifestyle-related illnesses, with the non-communicable diseases now accounting for approximately 63% of Indian deaths, is further intensifying the need for comprehensive healthcare. The market has also seen an increasing demand from medical tourism after a decline due to COVID, with the foreign patient numbers nearly doubling from 480,000 in 2022 to 730,000 in 2024, contributing 10 to 12% of hospital revenues, and is expected to reach $18 billion by 2027. This increase is directly attributable to the fact that healthcare services in India cost just 50% of what they do in developed countries. Another pivotal element in this growth story is the government's proactive policy support and the increasing expenditure on healthcare. The Union Budget 2025-26 raised health allocations by an impressive 11% to 99,855 crores, and the Department of Health and Family Welfare compared to the previous fiscal year. Welcome to Bottom Line by Groww. Now that we've unpacked the demand drivers that are fueling India's healthcare boom, let's zero in on how leading chains are performing on the ground and the key risks and challenges that they must navigate. The private sector's dominant and expanding role is a critical aspect of India's healthcare landscape. While healthcare services are provided by both the government and private players, the provision of services is skewed towards the private sector. As such, the private sector accounted for 64% of healthcare delivery revenues in FY19 and is projected to increase its share to roughly 69% by FY28. While a 5% increase in the private sector market share might seem modest, the impact in absolute terms is striking. For example, a 5% share of the market was worth 195 billion rupees annually in FY19, but is expected to grow to 490 billion in FY28 as the market expands. The incremental annual benefit of 295 billion rupees for private players, a significant opportunity for hospitals. This shift is propelled by the rising incomes and the increasing insurance penetration, which boost the demand for higher quality care offered by private facilities. For instance, nearly 573 million people were covered under health insurance in FY24, a significant increase from 288 million in FY15. Hospitals in India fall into three tiers by complexity and capacity. Primary care clinics handle routine checkups and vaccinations but lack ICUs or operating rooms. Secondary care facilities perform general medicine and routine surgeries, referring the complex cases onwards. And tertiary care, dominated by chains like Fortis, Apollo, and Max, ranges from 200 to 1,500 beds, boasts of advanced technologies, specialists, and manages high-end procedures. Turning towards the revenue mix, it splits into patient bed charges, doctor fees, diagnostics, consumables and procedure fees, and outpatient consultations, minor surgeries, and lab work. Although OPD accounts for 75% of visits, IPD drives 71% of FY24 revenues, underscoring the complex, high-value services that are most profitable. A point to note is that healthcare demand is non-cyclical. Even during global recessions, revenues hold up and margins dip only modestly since people do require healthcare regardless of the broader economic conditions. However, hospitals are capital intensive. Land, construction, equipment for tertiary care in the Tier 1 cities costs around 10 to 12 million rupees per bed. New facilities endure a gestation period of initial losses until occupancy rises, where mature hospitals then spread sunk costs over more patients, steadily improving margins and bringing in steady cash flows. For example, at Global Health, as of FY24, mature hospitals saw a 10.6% increase in total income and a 12% increase in EBITDA, a 5% increase in occupied beds with an EBITDA margin of 24.8%. Developed hospitals, by contrast, posted a 10% income growth and an 18.7% surge in occupied bed days, yet EBITDA climbed by only 1.8%, translating into a margin of 30%. Therefore, it's important to evaluate the composition of mature versus developing hospitals. Moving on, let's examine the major players in this sector against the key metrics unique to the hospital industry. First is occupancy rate. This is the percentage of operating beds that are occupied, calculated as occupied bed days divided by available bed days. A higher occupancy rate generally indicates more revenue, profits, and efficiency and community trust. As of FY25, Max Healthcare led the pack with the highest occupancy of 75%, driven by its strategic focus on high-demand metropolitan markets. Max Healthcare concentrates 78% of its bed capacity in metro cities like Delhi and Mumbai, targeting robust patient demand. It also draws substantial volume of patients from outside its immediate operating regions, with approximately 30% of its patients originating from upcountry locations. This broad patient base helps it to sustain high occupancy rates. However, occupancy shouldn't be viewed in isolation. For example, Narayana Hrudayalaya's utilization remains at 46.57% in FY25. Now, the company's business model includes a significant presence in smaller cities. Here, patient volumes mature more slowly than in metros. Even fully built, these facilities often run at suboptimal occupancy for a few years as local referral networks and brand awareness take shape. Moreover, the hospital's focus is on treating complex, high-acuity specialties, which tend to have longer average lengths of stay but lower daily turnover of patients compared to the general hospitals, and that affects the occupancy metrics. More importantly, the group prioritizes efficiency and high-value care over simply filling beds. As such, despite having a low occupancy rate compared to its peers, EBITDA margins have expanded by 7.3% over the past 4 years, and PAT has also improved. Second, the average length of stay measures the average number of days an inpatient spends in the hospital from the admission to the discharge. Shorter ALOS generally signals more efficient care pathways and faster patient throughput, allowing hospitals to treat more patients with the same bed base and improve their revenue per bed. Moreover, most of the big-ticket diagnostics, procedures, and specialists' costs occur in the first few days of an admission, while the additional days largely incur routine nursing and overhead costs. So, a shorter stay shrinks the costs of care per discharge by avoiding these lower value marginal bed day expenses. Thus, hospitals aim for lower ALOS with an average length of stay of just 3.2 days, lowest among its peers. Global Health strategy hinges on high volume of daycare and outpatient treatments delivered through dedicated centers that discharge patients on the same day. Moreover, by focusing on the short case specialties like ophthalmology and orthopedics, while keeping the long stay segments such as neurosurgery relatively modest, The company drives down its overall ALOS. In contrast, Narayana Hrudayalaya has the highest ALOS of 4.5 days, driven by cardiac and oncology heavy case mix, requiring extended post-operation care and deliberate focus on value-based high acuity services in Tier 2 and 3 markets. Third, the average revenue per occupied bed per day. This metric is calculated by the total hospital revenues divided by total occupied bed days. It varies by hospital type and geography, with premium tertiary centers typically having higher ARPOB due to the complex procedures and clientele. Boasting an industry-leading ARPOB of 73,000 rupees, Max Healthcare's premium yield reflects its metro-centric network of 78% of beds in Delhi and Mumbai, where higher incomes and insurance penetration command top tariffs. A strategic focus on complex quaternary and high-end tertiary procedures further elevates rates, with oncology alone accounting for over 25% of gross IP revenue, alongside significant cardiac and orthopedic volumes. Finally, a payer mix weighted towards self-pay, private insurance, and general patients further elevates the blended ARPOB, since these categories pay higher rates versus the government schemes. On the other hand, Narayana Hrudayalaya has the lowest average revenue per occupied bed per day at 43,600 rupees because it deliberately focuses on volume over price. It treats many patients under the government schemes like the CGHS and Ayushman Bharat and operates largely in smaller cities where the tariffs are naturally lower. Moreover, guided by Dr. Devi Shetty's affordable healthcare for all vision, Narayana Hrudayalaya skips the deluxe suites and the extra add-ons, filling beds to spread costs across more patients. Lastly, another parameter to look at is the payer mix, which refers to the distribution of a hospital's revenue across different payment sources. At one end of the spectrum, Global Health earns 57% of its revenue from self-pay patients, and Narayana Hrudayalaya draws 46%, reflecting their focus on value-driven, price-sensitive markets in smaller cities and high-volume specialties. At the other end, premium chains like Apollo, Max, and Fortis have built deeper insurer and corporate partnerships, driving their self-pay shares down in favor of contracted businesses. Apollo leads the corporate segment with 44% of revenue, followed by Max at 38% and Fortis at 37%, while Narayan and Global Health lag behind due to fewer employer tie-ups and more regional footprint. In institutional schemes, government programs, CGHS, railways and PSUs, Fortis and Max each secure just over 20% of their business. Narayan captures 19% through its social mission branding, and Apollo and Global Health each hover around 10%. Finally, in medical tourism, Max commands 8.8%, Fortis 7.8%, and Apollo 5%, and both Narayan and Global Health at 4%. Overall, over the past 5 years, India's top private hospital chains have not only delivered strong double-digit revenue CAGRs, but have outpaced those gains with even faster profit growth, a clear sign of widening margins. This profit outperformance reflects a mix of factors common across the league: higher insurance penetration and corporate contracts that shift volumes toward better paying segments, rigorous cost controls, and scale-driven operating leverage, premiumization of service lines, and the rollout of digital and asset-light care models that boost efficiency. As profitability has surged, share prices have followed suit, with Max leading with a 51% stock price CAGR, Narayan and Fortis delivered mid-40% gains, and Apollo a 39% uplift. Consequently, leading chains now trade at an EV/EBITDA multiple of roughly 30 to 60 times, well above their 10-year medians. This premium reflects the confidence in sustained margin expansion and strong ROEs, but leaves little room for error if profit growth slows. To drive future growth, hospitals across the payer group are setting aggressive capital expenditure plans. Apollo Hospitals is set to invest approximately 5,500 crore rupees over the next 3 to 4 years to add around 3,600 beds, with an additional 450 to 500 crore rupees annually dedicated to maintenance. Narayana Hrudayalaya has earmarked 2,974 crores for its expansion efforts. Meanwhile, Global Health plans to invest 3,500 to 4,000 crore rupees over the next 5 years and add around 3,000 beds, while Max Healthcare has committed 5,827 crore rupees through FY28. These substantial investments highlight the industry's bold strategy to scale capacity and meet rising demand. The key question remains, will these capex efforts deliver the returns needed to justify their premium valuations? As of 2022, India has allocated around 3.3% of its GDP to healthcare, which is below the average of 5.1% for developing countries. Additionally, India's per capita healthcare expenditure is approximately $80, significantly lower than the average of $354 for developing nations. Even India's hospital bed density stands at merely 18 hospital beds per 10,000 people, which is considerably lower than the global average of 30.7 beds and lags behind peers like Vietnam and Brazil. However, despite hospitals working to address the capacity gaps and scale up to meet the growing demand, the healthcare industry continues to face significant challenges. First is regulatory risks. Sudden regulatory changes are perennial risk. For example, the National Pharmaceutical Pricing Authority, or NPPA, introduced price controls on various medical devices, including stents and knee implants. For instance, in 2017, capped prices for drugs eluting stents stood at 29,600 rupees and bare metal stents at 7,500 rupees. Suddenly, this change affected the pricing structure for cardiovascular surgeries, impacting hospitals and medical device manufacturers. Ayushman Bharat, launched in 2018, set limits for the reimbursement amounts for the surgeries under its coverage, effectively setting a cap on how much hospitals can charge for various surgeries. Thus, any adverse policy on pricing could squeeze margins. Moreover, the Supreme Court has criticized the government for ignoring a 2012 rule that requires it to work with the states to set standard hospital fees, even as private hospitals charge 2 to 3 times the official CGHS rates. The court has warned that if the gap isn't closed, it will impose those lower CGHS tariffs itself across the country. That move would squeeze the hospital profits, create pricing uncertainty, and force some of the high-cost treatments out of reach, completely discouraging fresh investments in the sector. Second, the increasing insurance coverage is a double-edged sword for the hospitals. While increasing insurance penetration may initially seem like a boon for the large super specialty hospitals, it often shifts pricing power from hospitals to the insurers. In countries with high insurance penetration, insurers control the patient treatment locations and demand lower reimbursement rates for network hospitals. As a result, hospitals become price takers even when performing complex procedures. Additionally, insurers delay payments, contrasting with the walk-in patients who pay upfront, leading to longer receivables and stretched working capital. As insurance penetration grows in India, hospitals may face reduced pricing power, impacting profit, margins, and revenue, while increasing working capital requirements. Now, with demand holding strong but looming CGHS price caps squeezing margins, can private hospitals sustain their premium valuations, or will investors demand a rethink?
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and/or other instruments traded on the stock exchanges.